The accounting cycle is a series of steps or processes that businesses and organizations follow to record, analyze, and report their financial transactions. It provides a systematic framework for managing financial information and producing accurate and reliable financial statements. Key points about the accounting cycle include: 1. Identification of transactions. The accounting cycle begins with the identification of financial transactions, including sales, purchases, expenses, revenues, and other economic events that impact the entity's financial position and performance. 2. Recording transactions. Once transactions are identified, they are recorded in the accounting records using double-entry bookkeeping principles. This involves debiting one account and crediting another to ensure that the accounting equation, assets equals liabilities plus equity, remains in balance. 3. Posting to ledger. Recorded transactions are then posted to the appropriate accounts in the general ledger, which is a central repository of all accounts used by the business. Each account in the ledger maintains a running balance of transactions affecting that account. 4. Trial balance. At the end of the accounting period, usually monthly, quarterly, or annually, a trial balance is prepared to ensure that the total debits equal the total credits in the ledger. The trial balance serves as a preliminary check on the accuracy of the accounting records. 5. Adjusting entries. Adjusting entries are made to update account balances and ensure that they reflect accrual accounting principles and match revenues with expenses in the period they are incurred. Common adjusting entries include recording accrued revenues, accrued expenses, prepaid expenses, and unearned revenues. 6. Adjusted trial balance. After adjusting entries are made, an adjusted trial balance is prepared to verify that the ledger accounts reflect all adjustments and that the accounting equation remains in balance. 7. Financial statements. Based on the adjusted trial balance, financial statements are prepared, including the income statement, balance sheet, and statement of cash flows. These statements provide stakeholders with information about the entity's financial performance, position, and cash flows during the accounting period. 8. Closing entries. At the end of the accounting period, closing entries are made to transfer the balances of temporary accounts, revenue, expense, and dividend accounts to permanent accounts, income summary, retained earnings. This process resets the temporary accounts to zero and prepares them for the next accounting period. 9. Post-closing trial balance. After closing entries are made, a post-closing trial balance is prepared to verify that all temporary accounts have been closed and that only permanent accounts remain open. 10. Reversing entries. Optional. Some businesses use reversing entries at the beginning of the new accounting period to simplify the recording of certain transactions, such as accruals and prepayments that were made at the end of the previous period. Overall, the accounting cycle provides a structured and systematic approach to managing financial information, ensuring accuracy, completeness, and compliance with accounting principles and standards. By following the steps of the accounting cycle, businesses can produce reliable financial statements that enable stakeholders to make informed decisions about the entity's financial health and performance.